Well, thank you very much for coming to another session of the Smart Strategy System. Today we will be talking about a topic which is very important for anyone that has studying price action, and that is volatility. And I will show you an indicator I've created called Volatility Valuation. Now, before diving into the presentation, I'll just give you a synopsis of what we'll be doing. First, we'll be doing a theory, talk about the big general about valuation, then talk about some tools, and then my indicator, volatility valuation, so you can see where I'm coming from. So let's begin with the indicator. First of all, the usual risk warnings. As always, there is a very high degree of risk involved in trading, and past results are not indicative of future returns. Smart Trader Systems Limited and all individual affiliated assume no responsibilities for trading and investment results. I mean, your losses, both losses and wins, are rely solely with the person pushing the buttons, the buy and sell buttons. And I have only one guarantee when it comes to trading, and that guarantee is that you will have losses in trading. So with that said, let's begin. There will be some attendance bonuses for those that manage to stay awake during the presentation. First of all, the first gift is that in 2022, I wrote a paper called M.T.M.F Volatility Normalised Momentum. I created a new indicator. Basically, well, it's not exactly a new indicator. It is an improvement of the MACD, and it's called MACDV. It improved the 5 flaws or limitations that the classic MACD has. And I submitted this paper, and it won 2 international awards. First of all, the Founders Award by the National Association of Active Investment Managers, for advances in active investment management, and also the Charles Darwin Award by the CMT Association, which is 2 awards for this paper. So the first bonus is if anyone that contacts me, I will give them this paper, of course, for free, so they can see what this paper and how people can improve the momentum and the MACD in general. The second thing is I have the MACD indicators, both the MACD and the histogram, have been embraced by the community, and they're being added on TradingView. It's already on stock charts, MetaStock, MT4, Optima, and other trading platforms are being added as we speak. So again, contact me so I can give you the details if you use a particular trading platform. And third, there will also be running some momentum models, some advanced version of the MACD webinars. So again, feel free to contact me, so I can send you the information how to get your 3 gifts, 3 bonus, your attendance bonuses. So with that, let's begin the presentation. First of all, context before content, because I always like to show people the big picture, what is where we're coming, where this today's presentation fits in. So how do we go from being scattered, having a scattergun approach to analysis and trading, to being very systematic? So the Smart Strategy System, which is one of the systems I use for the Smart Trader System, is actually helps you with this, how to go from being scattered to being systematic. So what is the roadmap? So there are 3 stages. First of all, I look at the macros. I try to combine both technicals and fundamentals. That's where I have a multiple time frame, multiple factor approach. So first of all, I look at the macros, the fundamentals, which answer the question why. Now, macros are very important, fundamentals, because markets don't move because of charts and oscillators. They move because of macroeconomic factors, fundamental factors, and these answer the question why. And I usually do this analysis on the monthly and weekly time frame. Then I look at the daily chart, and I look at the markets themselves, which is the when. This is technical analysis. So fundamentals answer the why, technicals answer the when. And I do this, I do technicals usually on my daily time frame. So that's why I have a multiple time frame, multiple factor approach. So fundamentals monthly, weekly, technicals on the daily. And once I've got all that information I want, and I'll show you in my next slide what are the factors I look at for for macros and technicals. Then I go into creating a system. What are the 5 steps to create a system? A trading methodology, if you will, which of course you can follow either systematically or semi-systematically. Okay, so let's look at the macros, the markets, and the model. So when it comes to macros, what do I look at? First of all, I check on the monthly chart, the business cycle. That's my first step. And each step has rules around it. It's a rules-based methodology. So the first thing I look at this business cycle for stages in the business cycle. Then I go to the weekly chart and look at the intermarket cycle, 6 stages to the intermarket cycle. Then I go into the commitment of traders report. The commitment of traders report, again, I look at it shows the positions of the biggest traders, whether they're speculators or commercial, but of course small traders. And then I go into the weekly chart, I stay on the weekly chart and look at market sentiment, another very big important factor. And then look at seasonals. So like I mentioned, this is a multiple time frame, multiple factor approach. Then I look at the markets, the technicals. So switching to the technicals, which factors do I look? Again, multiple time frames, multiple factors. Which factors do I look for technicals? So the first factor is I look at the trend. I build a trend roadmap, a market map, so to show me what are the various stages of the trend. Then I look at relative ranker. Basically, relative ranker is when I have markets classified in various stages of the trend. Then I try to see them, to rank them from strongest to weakest. So I can see which markets are strongly trending up, which are strongly trending down. Then I look at MACD, which is the momentum indicator I spoke to you before. So trend, relative strength, and momentum. Trend shows you the direction. Relative strength is your odometer, and momentum is your speedometer, if you want to put that analogy. Then I look at swing structure. Again, it's basically a configuration of starting the highs and the lows, pattern recognition, if you will. And then finally look at volatility. And this is what we'll be talking about, and hence why this part of the presentation is called context before content. So I'm just showing you where the big picture, where it resides, because each analysis methodology, each factor I'm watching has its own place. So this is, we'll be talking about step number 10, volatility valuation. And then I bring all this multiple time frame M.T.M.F approach, multiple time frame, multiple factor, into a system. So how to create a system? Methodology will. First of all, a strategy selector. Strategy selector basically is, there are various types of strategies. Mean reversion, trend following, or different holding periods like swing trading, 1 to 5 bars, or you go like position trading, what I call from 2 to 4 weeks, and then you go like investing stuff, which you hold out for weeks to months. So first of all, I choose which type of strategy I want to have. Then I look at the setup, the 5S framework. S for setup, the second S. S is setup basically is the factors that I look at if to come to a conclusion if the market is directionally bullish, bearish. Of course, it can be neutral. But so the first 10 steps are for me to get a directional bias. So they want to be basically playing the market long from the long or the short side. Then I look at the signal, where to actually get in the market. Now, a market may be bullish, but unless I have a signal, I won't get in, and vice versa. Even if I have a signal, unless the market have the right setup. So when the setup is bullish, I will only take buy signals. So if a sell signal comes, I will ignore it. And then I look at the stop where I will get out, and then of course the position size. So this is my framework, and corresponds to the smart trader system, which will, of course, we can have another webinar about. So, like I mentioned, we'll be talking about volatility valuation, and we'll break down the presentation into three parts: theory, tools, and techniques. Theory, let's begin. Theory. What is volatility? Volatility is the amount of fluctuation you have. It doesn't refer to trend, but it talks about the fluctuation around the trend. So for example, if you have a stock, suppose you have the two stocks here. Of course, it can be any market. It can be two currency pairs, two bonds, or two different asset classes. So let's say the blue colored one and you've got the black colored one. So basically, this go from on the chart from 0 to 100. They start from one price, let's say not zero. Let's say from $1 they go to 100 or 80 to 100. It doesn't really matter. But you can see, although they start and they finish to the same exact point, the fluctuation matters. And of course, this fluctuation is volatility. So how do we measure it? So that's the theoretical part. So let's go into the tools. So how do we actually measure volatility? And volatility is actually very, very important because it can impact all parts of your trading framework. So for example, we talk about setup, signal, stop, and size. So it can impact your setups. Basically, if you want to be choosing, if you want to have higher volatility markets, also your entry techniques. You can have many entry techniques around using volatility measures, which we'll see later on. You can also impact your stops. Market obviously is trending with a lot of volatility. You want to be placing your stop a bit further away from the market, and so on and so forth. So volatility is a big factor. So what tools can we use to measure volatility, to flesh it out? So let's begin with the basics, the core. Let's introduce you to a one thing we call true range. Range versus true range. So what is the difference between range and what we call true range? So this is a bar we have. It goes from 90, a low of 90 to a high of 100. Open 92, the closest is 98. So what is the range here? The range here is, 10. From 100 minus 90, it goes to a range of 10. So we have the next bar, which is from a range of 110 to a low of 102. The high is 110, a low 102. So what is the range here? Feel free to type it in and let me know what do you think the range is. Yeah, Sarah says it's 8. And that's the guess that most people have, correct, 8. But I would beg to say that this is range, and I will introduce you to the concept of true range. What is true range? Now, if you look closely between these two bars, you will find that there is a gap between them. Gap means that the high of the bar 1 is lower than the low of bar 2, which means one is 100 and the next one is 102. So you had a gap. So the true range isn't just from 110 to 102, but we also should include that gap as well. Because, for example, imagine having your market close at 98 and then the market rising all the up 110. So you would have pocketed, assuming that you were long, that difference between that gap as well. So that is that gap we're talking about. So true range is actually 12 because it is the difference between the high of bar 2, 110, minus the close of the previous bar. Because as aforementioned, when the market closed at 98, so and it went all the way 110, that's its true fluctuation. So the true range is accounting for that gap as well. And obviously you're measuring it from the previous bar's close. So this is the formula for true range. It's pretty standard. If you go to any charting software and plug it in, you will get the definition of, you will get the calculation for true range. It's not something that you have to do manually. And the inventor of true range was a guy called Wallace Wilder. He was the one that also did the RSI, invented the RSI. So again, here are some more examples. Bar 3, that's, and then you have bar 2, there's a gap. So its true range is 202 pips. This is the EuroFX chart. And bar 1 has a range of 44. Again, this is how it would look like on a chart. The true range, you would measure the range for the true range for each bar. So for bar 2, 202 pips, large range bar, and then the next day inside bar, 44 pips. So this is how it would look like for EuroFX. The true ranges, as you can see, when you have large range bars, you have big values for the true range. When you have small range bars or inside bars, small ranges. So now that we've covered true range, what is the next concept, the basic concept? We should be looking at average true range. What is average true range? Average range, of course, is when you take each of these true ranges and you add them up and then divide them by the number of observations you have. So why do you want to do that? Because true range answers what is the volatility for one bar. So if I'm going to ask you the question, what was yesterday's volatility, or the day before that, or the day before that, you would have an answer through true range. But if someone asks you what has been on average for the past, say, 2 weeks, 10 bars, if you're looking at the daily time frame, or for the past 20 bars or 50 bars, so you have to, obviously sum them up, divide by 50, 10, or whatever your look back period is, and answer the question, what has been in average the volatility for this period. So for this example, I use the average range of 10. That's basically 2 weeks, 5 bars in a week. So on the top part, we have the chart of euro. The middle part, we have true range, and then we have average true range. So you can see how it fluctuates. So true range for the last bar was 44 ticks. Our average true range was 74, and it was 74 because obviously it doesn't count just the last bar, but always for the period. So if someone asked you the question, what was yesterday's true range, we would say 44. But what has been on average for the past couple of weeks, it would be 74 ticks. And that, as you can see, the volatility is volatile, as they say, it fluctuates. So currently it's at 74 ticks. And it can be, of course, much higher or much lower. So 74 ticks. But the problem here is you've got 74 ticks. Now, if you compare this for the DAX, you have ticks. If you go, for example, the Dow, you have another measure of value. If you go for, if you do it for shares or stocks, you will have it for pence or cents or dollars, depending on the currency that is denominated. So how do you compare apples and oranges to oranges? So how can you actually compare volatility for across markets? Well, and this is exactly what I'm showing, just showing visually what I've just said, what the problem is. So on the left chart, you've got euro, average range 74. And then on the left one, on the right one, you've got the Dow, you've got an average range of 159. Does this mean that the Dow is twice as volatile? No, because 74 ticks, it's a low priced item. The EuroFX, it's an absolute price indicator, as we say. But the Dow has measured in thousands of points. So it's obviously that since it's an absolute price indicator, it will have a higher absolute price. So 159, it seems that it's twice as much as euro, the volatility true range. But it's not really, because as I mentioned, we compare apples to oranges. So this brings me to the next point, is how to do normalized average true range. So to normalize it across markets. So how do we do that? Again, we take this is the formula, we take the average true range, divided by the close, and we do that in order to show what is the absolute fluctuation as a percentage of the price. So it's different to be fluctuating, say, 50 ticks for a $100 stock and 50 ticks for a $200 stock. The true average range will show it's 50 ticks one, 50 ticks for the other, but it's much different when you compare it to what the price of its market is. And like I mentioned, it can be ticks for shares, it can be for futures, it can be pips or ticks again for FX. It really doesn't matter. It goes across time frames, across markets. So what you do is you take that absolute price divided by the price, the absolute price of the underlying market, and multiply it by 100 to give it a percentage basis. So again, now it's normalized, so you're comparing apples to apples and oranges to oranges. So this is how your chart would look like. So what we saw before as 74 ticks now translates to 0.7%. So if someone asked you how much has the euro fluctuated in the past 10 days, 10 bars, 10 days, because we're looking at daily charts, you would reply 74 ticks. So, but if you want to be putting it in percentages, you would say 0.7%. Now, take a look at the Dow we spoke before. The average true range would be 159, but if you, so it seemed to be twice the average true range of the euro. But if you put it in percentage, it's 0.79, so it's practically the same. So you can see that by normalizing, you see you don't have twice the volatility, but it's actually the same, 0.79%. And you can do this calculation for each market. So you can normalize the volatility for something like Bitcoin versus Canadian dollar, or versus Australian dollar. It really doesn't matter. So we normalize that. So we go from theory to tools to techniques. Now, this is where it gets really interesting, because volatility, as we have calculated so far, we've answered 3 questions. So what is the true range? What is the volatility of the past bar? Average true range, what is the past over the past X number of bars? And normalizing it is how we can compare it across markets. But I've always had the thing with that, with this calculation, because there was also something missing. And the missing part was that it never got to tell me where volatility is high or low. So, okay, it's 0.79%, or it's 1%, or it's 2%, but is that 2% high or low? So, and of course, as you can, if you play around with, study enough markets, you see that each market has its own volatility structure. So what is high for one market may be low for another. So 2% may be extremely high for bonds, for biostocks, or natural gas, or Bitcoin. 2% is like, it's Tuesday. It's nothing. These are highly volatile markets. So it doesn't tell if it's high or low. And this is where I wanted to take it a step further. So what I created is volatility, first of all, volatility trend, and then volatility valuation. So volatility trend is the, sorry, I may have jumped ahead a few slides. So let me rephrase that. Not only I wanted to see whether volatility is high or low, but also want to see its trend. Is it increasing or decreasing? So how did I see if volatility is increasing or decreasing? It's very simple. I plotted a moving average on the normalized ATR, and if the if the volatility was above its moving average, then I said volatility is increasing. If it's below, it's decreasing. And here's a chart, the Dow Jones Transport Average, but again, like I mentioned, you can do it like any FX currency pair. And I've had the average true range on the chart and plot the moving average. So if the average true range is normalized above the moving average, then volatility is increasing. If it's below, it's decreasing. Very simple. So if someone wanted to see if it's increasing or decreasing, you can do it this way. Again, very simple techniques. But the fact that they are simple, it doesn't mean that they are less effective than something complex. You don't need complexity. So this is extremely simple, but also very important. So which brings me to the next point, which I feel may have jumped in ahead a bit, is the volatility valuation. So with volatility trend, we talked about whether it's going up or down. With volatility valuation, again, now it's the part of the presentation where I should be answering whether volatility is high or low, because the trend will tell you if it's increasing or decreasing. Which is very important, because a 0.79% doesn't tell us if it's 0.79% coming off of a low or coming off of a high, increasing or decreasing. But volatility valuation doesn't tell you if it's just increasing, but it also will tell you if it's high or low. And that is very important. And that is a discovery I made. And actually, I got the idea from John Bollinger, Mr. Volatility himself, when he said something that really stuck with me. And that's a meeting we had in 2010, actually. He came in London, and he said something that stuck with me. And he said, high volatility is where trends, low volatility is where trends are born, and high volatility is where trends go to die. So I've always thought, okay, that's very true and also very important, but how do we quantify high or low? What is high or low? Because so far we saw that volatility is increasing, but we don't know if it's high, or decreasing, and we don't know if volatility is low. So how do you do that? So I created the volatility, what I call a volatility valuation indicator, and this is how it fluctuates. I managed to normalize it across markets, and I'm showing you its template. It doesn't. It holds true across all markets, and that's the beauty of this indicator. So by and large, this is how it looks like, the volatility valuation indicator. And what I try to do is to see whether it is high or low. So it has a mean, which is around 1. Anything above 1 means volatility is high, but when it is extreme, it is usually around 1.3 to 1.4, or 30 or 40%, or 0.6 to 0.7. So whenever volatility is around 1.3 to 1.4, then it is high, extreme. When it is 0.6 or 0.7, it is extremely low. And as John mentioned, high volatilities go, high volatility is where market trends go to die, and low volatility is where they go, trends are born. So what I'll do is I'll show you some examples. I will switch off from the PowerPoint presentation to go to trading and show you some real life examples, not just the presentation ones. And feel free to ask any market that you may like, and show you some rules as well. So indicator and price trends. So I'll show you some rules. So this is at the bottom is the volatility valuation indicator. On the top part is a chart of gold. So usually when high volatility is extremely high, that usually marks bottoms. Now, not always, because we talked about trends, if you remember. High volatility is where trends go to die. Now, usually these are bearish trends, but let's just say it's trends in general. But by and large, it's usually bearish trends. So this is how it would look like. This is a chart of gold. High volatility usually bottoms, but not always, and I'll show you the exceptions as well. Again, another chart. This is for British pound. High volatility, extreme. Again, these are lows. Again, high volatility when trends go to die, usually have reversals. So rules of interpretation. First of all, indicator extremes, you have a trend of change or a trend reversal, which means they may die, but sometimes they don't die. They just take a rest. The indicator high is usually at the bottom, but not always. And the indicator lows are usually but not always associated with the top. And also a very, very important point, the indicators are warnings, these are setups, not signals. Right? So when you have very high volatility, it means that your trend may change or reverse, but this is a warning. The actual signal will come from the price action itself. These are setups, not signals. Okay, also always check the chart, volatility valuation extremes and the market trend. So as we see, so in this particular example, you see the high volatility went with a top. Huh? The principle that when trends go to die, that was true, but this time it was at the top. And next, the second volatility valuation high point was with the bottom. Again, the principle held true that this is where trends go to die. But this time was with the top. Usually it's with the bottoms, but you have to be wary, check the chart. So never forecast. Here's an example. High volatility here, the trends didn't exactly die, but they just took a rest. So the volatility extreme led to trend change, not reversal. So you can use that not just for your entries, but also for your stops. Very, very useful information, because if you were lucky enough to be in a position during this market uptrend, when volatility goes so up, you could use it as a sign to tighten up your stops. So don't look at it just from a setup or point of view. You can also look at it from the stop point of view, because if you remember, we mentioned that a stop strategy has the Forest framework, setup, signal, stop, and size. So it can affect not just the setup, but also the stop. Indicators are, again, as I mentioned, indicators are not systems. So here an example, the market kept dropping, and volatility valuation went over the extreme, but as the market kept falling, the indicator kept rising. It got basically volatility got more and more extreme. So it's sort of like momentum. You can have a lot of momentum, but it's not. So it's not a timing tool. It's a setup tool. Don't fall in love with it in the wrong way. Again, of course, you can use it as an entry filter. Say, for example, if you want to test your systems or your methodology, say, okay, I don't want to be taking highly volatile, or want to be tracking very high volatile. There are a lot of ways to use it. And of course, you can use it as an exit filter. For example, when you're at the extreme zone, the market is falling, or rising, and you're short. Again, as I mentioned, you can bring the stops closer to the market or close your positions at this level. So it's monitoring volatility, and of course, the volatility valuation indicator is extremely useful for many reasons, both if you're out of the market and you're looking to enter, or if you're in the market and you're looking to exit. So to recap, So first of all, what did we talk about? First, we'll talk about true range. So what is the volatility for one bar? Average true range. What is the volatility for a period of bars? Then we talked about what is average true range, which is trying to normalize volatility for across markets. We talked about volatility first, the trend, and also lastly the smart volatility valuation. This is my proprietary indicator to show if it's high or low, and that is, I think, was the next step. And with that, again, I would like to show you the attendance bonuses. What I will be doing is I will be switching from PowerPoint to TradingView, so I can show you some charts. Feel free to give me names of any market you would like to see. We can start from FX, say probably. My idea was to take you from Euro and then Pound or any kind of market you may be interested, gold, oil, and see how the volatility valuation indicator works. Now, again, feel free to contact me for the attendance bonuses. And let's switch to, let me see if I can get this right. Let me see if I can, I'm not sure how all this is. I hope I don't mess it up. Can you see? All right, now perfect. I think, can you see? Please let me know if you can see trading here. Because I'm just trying to find how WebEx works. Send me a message if you. Perfect. All right. Okay. Okay. So this is a chart of cotton futures. I was actually looking for this market. Let's go into how we look at FX. All right, so let's go to euro. Let's look at the chart of the euro. Now, I hope you can see the crosshairs I have here. So high volatility. Again, let's scroll and see. As you can see, for the since 2023, we had a couple of volatility valuation. Here, volatility valuation here, extremely low was at the bottom. Here, extremely low was at an inflection point here at an extreme here. So the two signals we had here were spot on. Let's see some more. Again, volatility valuation high, bottom, volatility valuation high, bottom, volatility valuation high, bottom, volatility valuation high, bottom, volatility valuation high. Here it was a top, but you can see it's always at an extreme. Volatility valuation here, bottom, volatility valuation here, top. Let's see some more examples. All right. Again, volatility valuation here, top, volatility valuation here, top, volatility valuation here, the bottom. But again, as you can see, because this is an unbounded indicator, as soon as you go into the area of extreme volatility, it didn't mean that you have to sell short or buy, because you can see it can stay for a prolonged period of time. As you can see here, it kept rising and rising and rising all the way here up capitulated, but it is a setup tool. Again, but it's still, you can see when it capitulated was the bottom. Same thing here, it was the top. Again, capitulate at the indicator here at the bottom, at the top, and so forth. I can show you numerous examples. Let's switch to another example. Let's go to the British pound. Let's try to scale this. Let's scale. Okay, let's go to the beginning. As you can see, that's very, very, very interesting. As you can see, volatility valuations, now it's at an extreme. It's approaching an extremely low point. So we will start seeing the emergence of a new trend. As currently things stand, again, volatility valuation here around the top, volatility valuation here again around the top. Let's see here. High volatility valuation, bottom, high volatility valuation here, bottom, high volatility valuation, bottom, high volatility valuation here again, around the bottom. Sometimes it works extremely well as a timing purposes, but I'm just trying to caution that personally I don't use it for time, but it's an excellent setup tool. It's one of the 10 pieces that I look at, if you remember through my presentation. Right, from Costa, I got an from Costa, how would your volatility indicator be applicable for calendar spreads? Well, that's a good question. Costa, I haven't tried, I don't do calendar spreads. So the question, I don't have that, but let me look into it. And I can see if I can answer this. But that's a good question because I haven't, I'm not looking at calendar spreads. I'm a directional trader, but that's a good question. I'm sure we can, that's excellent food for thought. Feel free to contact me so we can follow it up. Alberto, yeah, waiting for the MACD action trading with, yeah, I will be doing it within the next 10 days. Sorry for the delay. Will you have access to this indicator on trading, Alberto? Yes, I will. I will have you all the indicators except the volatility valuation. It won't be for free. I mean, when you say access, I would assume, do you mean for free or not? For free it won't be, because it will be part of a training program I have to teach you the full 10 steps. So yes, it will be, but not for free. It will be part of a group that wants to follow my the training program I'm having. So if you want to be looking at any other market, please do let me know. Again, British pound, as you can see, very high volatility valuation went with the top, the bottom, sorry, very high volatility valuation went with the high volatility valuation again. So it usually, what indicator, Paulus, what indicator to use to check volatility? I think, I'm not sure if you logged in at the beginning of the webinar, Paulus, but let's just say to answer your question, the indicators I use is average true range. I show you true range, average true range, normalized average true range, and the volatility valuation indicator is proprietary. So you can feel free to experiment with the normalized volatility, normalized average true range, and volatility valuation is proprietary. So, but you can even without the volatility evaluation, I would suggest you start plotting average true range on your charts, get gauge your volatility. That's a very good start. Now I will have that on my TradingView account very shortly, both that and the normalized and volatility evaluation. Hope this answered your questions. Let me know if you've got any other any other questions and how we can, unless we'll be calling it a day. Nick, check BTC. All right, perfect. Yeah, okay, another chart request. All right, so let's look at gold. Let's look at gold, metals, precious. Okay, let's see how it works on gold. So, Nick, we're checking gold as we speak. Paulus, what did you say about the high volatility as in when it is 1.3 to 1.4? Yes, that is correct. That's when this is the range of the indicator when it's high and low. So, Paulus, does it mean the trend is dying? Or what did you say? Yes, it means that when high volatility is when trends go to die. Again, that's not my expression. It's not something I learned from John Bollinger. I just try to quantify his principle. So when trends go to die means, okay, let's look at an example. Let's hit one bird. So the expression, two birds with one stone. So I'll answer both Paulus's question and Nick's. So Nick's is to check the gold chart, and therefore Paulus, does it mean trends die? Or okay, high volatility, when trends go to die, means whatever the trend is, up or down, this is when they reverse most of the times. Now, most of the time that trend is bearish, but not always. So always check the chart. So as you can see, high volatility. Supposing you didn't. Okay, let me help you out. So this is the volatility valuation chart. Suppose you were looking just at this chart before checking the price chart. So what I would do is high volatility valuation, and I check this quantitatively. I have a scanner which shows me which markets are at an extreme volatility, and then I go to check the chart and see what the actual trend is. So in this particular case, the market was uptrending. So when the indicator got high, this is where it was an extreme. Likewise, now you can see, similar to gold, it is getting extremely low. So it's been in a sideways trend. So I'm expecting gold to very shortly have a breakout. So the trend now from going from neutral, I expect it to have a breakout. Now, do you want to have a breakout to the upside or to the downside? Now, this is where you go. The macros will be very important for us. Check commitment of trader report, check at sentiment, and so on and so forth. So again, high volatility valuation, the trend was up, so we'll be looking for it to die, and it died for a couple of months. Again, high volatility valuation, the trend paused for a while. Again, high volatility valuation, the market stopped for a while. Again, high volatility valuation marked the top. So what was the other, again, we get high volatility valuation marked the bottom. High volatility valuation marked the bottom. Nick, I hope this is okay for you. High volatility valuation marked the top. High volatility valuation marked here the bottom. I hope this is okay with Nick and with Paulus answering your question both at the same time. High volatility valuation marked the bottom. Again, high volatility valuation marked the top, or at least the trend died at least for a while. A high volatility valuation again was the top. So let's check out a really, really volatile market. Bitcoin. So this is probably, I mean, before the emergence of Bitcoin, I think the most volatile market you could check was natural gas. And I'll show you something really funny. Let me switch into the weekly chart. Guys, talk about market sentiment. Guys and gals. Yeah, look at that. I had actually noted it because I wanted to include another presentation. November 2022. That's the importance of market sentiment. Let me close the volatility valuation for a while. Now, this is the point, at this point exactly, November 2022, when The Economist and other magazines started publishing November to December, publishing the death of Bitcoin. It marked the bottom. And this is one of the points where it's also very important to be checking market sentiment. Now, I won't be just using magazine covers, although there is an indicator called the technique called the magazine cover indicator. But this is also, again, how important it is to be checking sentiment. That's the, of course, point of another presentation we'll be doing on sentiment. So let's go back to volatility valuation. And with that, I think we'll probably be, don't want to be running over time. Stop the presentation. Again, high volatility valuation, extreme. High volatility valuation, here was an extreme for some period. Now it has entered high volatility, extreme volatility. Again, extreme volatility here marked the bottom. Extreme volatility here marked the top. Let's scale it so we can see this properly. Again, high volatility here marked this top. High volatility here marked this bottom. High volatility marked this bottom. Then it went sideways, and then the new trend was born. Again, we're talking about a very, very notoriously difficult market to trade. Bitcoin, high volatility, extreme volatility marked the bottom. Where else? Again, extreme volatility here marked the bottom. I went into a trading range. You got another signal, an alert from low volatility. Then bang, the market started trending. So with that, I would like to let me switch back to the presentation. I hope you're I hope you're watching the PowerPoint now. So with that, I would like to let me take me to the last slide. No, actually no. We have to go to the last slide. So this is the contact information. If you'd like to receive the gifts or any other kind of information, hopefully I will be having this very soon on TradingView. With that, I would like to thank you all very much for your attendance. You've been a wonderful audience. I really enjoyed your questions, very thought-provoking. Nick, again, I will be looking into the calendar spreads question. Very good one, very thoughtful one. And with that, I would like to thank you all very much if there are no other questions. And wish you all to have a very good day and take care.